Hi everyone, Nick here, welcome back. New and experienced investors need to plan for having multiple investment accounts. It's almost unavoidable since you want to use tax advantage accounts like 401ks, IRAs, HSAs, and so on. But how do you allocate your investments across all these different accounts? Each may have different investment options, different tax treatment, and so on. This can be a little complicated as you build your portfolio or withdraw from it in retirement. In this video, I'm going to discuss goals and strategies for constructing your portfolio across multiple accounts. First, we need to consider the goals of our asset allocation as it relates to multiple accounts. We want it to help us achieve our desired allocation. Then we want it to be scalable. As we grow our portfolio, we want it to grow with us. And then as we enter retirement, we also want it to scale down with us as we withdraw from that portfolio. Ideally, we want it to be as simple as possible. We don't want a bunch of extra complexity to manage. Then we might want it to be tax efficient and have low fees. These are really optimizations to help lower the costs or the amount of taxes we're paying. Now, some people will balance simplicity versus tax efficiency or lower fees differently. Some people would pay extra for simplicity. Some people want to tinker to get that extra little juice out of the tax efficiency or fees. We're going to talk about two of the main asset allocation strategies across multiple accounts. The first is a mirrored allocation, which is where you just mirror your portfolio in each account. And the other one is a whole portfolio allocation, where you just consider the allocation across your entire portfolio. We're going to look at a couple examples of these. I've created this spreadsheet, which I'll link below. There's some fields in this you can edit. We're going to start with the overview, which just shows the desired asset allocation, 50% US stock, 30% international stock, and 20% US bond. We're going to imagine this is a couple with a $250,000 portfolio that's trying to figure out how to manage their allocation across these 5 different investment accounts. Both the husband and wife have a traditional 401k, an IRA, and then they have a taxable account. And the values across all of them differ a bit. Now on the next sheet, we have the mirrored allocations. We've taken that allocation from the overview page, we've broken it out by account, by asset class, by fund, which in our case doesn't really matter in these examples, but then we also have the amount allocated to each asset class or fund in each account. So in this case, each account matches the asset allocation exactly. So in his traditional 401k, we have 50% in the US stock, 30% in international stock, and 20% in US bonds. It's actually a pretty simple allocation. And we can visualize it down here in this chart. So you can really see that it's equally distributed across all of the different accounts. And one great option for this type of asset allocation would be target date retirement funds or similar life strategy or life cycle funds that are like an all-in-one balanced fund. The mirrored asset allocation is quite simple to understand. It's also very simple to manage and rebalance. The simplest way, like we discussed, is just to use the target retirement date fund and buy it in each account. Alternatively, you could simplify your portfolio a little bit using all-in-one funds like the Vanguard Total World Stock Index, VT, or VTWAX, and then just use a separate bond fund. It's another way you could get some of the benefits of the next strategy we'll discuss while keeping it pretty simple. So some of the downsides of this portfolio, it's less tax efficient. You may have bad options, investment options in some of your accounts. Like I've had 401ks with no good bond or international funds before, just actively managed ones. So if you wanted to mirror the allocation in that 401k, it might be quite costly and you might get an active manager that further degrades your performance. You might just be stuck paying higher fees or changing your asset allocation a little bit if you want to keep it simple and have this mirrored allocation across accounts. Another downside is small allocations, for example, REITs, can create small slices in your portfolio, which may interfere with your ability to hit investment minimums or qualify for premium share classes. Now, Vanguard used to have Admiral share classes, which required a lot more money. I think they still do for some of their funds, but they've merged most of them, so the investment minimum is much lower now at $3,000. And companies like Fidelity, most of their index funds have no investment minimum. So some of these aren't as relevant now, but they could still be relevant for some asset classes or some kinds of funds. So next is the whole portfolio allocation. So we'll make this a little interactive and fill this in as we go. Again, you can do this yourself with this spreadsheet. I'll put a link below. So one of the first things we want to do when constructing the portfolio is deal with the most difficult accounts first, where we have the least options and flexibility. It's typically going to be your 401k. So let's say that his 401k isn't very good, and maybe it has a decent bond option. And when you do tax-efficient asset allocation across accounts, I made a separate video on this, which I'll also link below, specifically on how to consider taxes when doing allocation in different accounts. But let's say we also generally want to put bonds in a tax-deferred account, since bonds will grow less, and in tax-deferred, you're going to have to pay taxes on your growth. So you typically want more bonds and deferred, and more stocks in your tax-exempt accounts like the Roth, since they'll grow more, and then you can avoid paying taxes on that growth. So let's say we have US bond, and let's just say the fund is FXNAX, Great Fidelity Bond Fund. Be lucky to have that in the 401k. And so we have $10,000 left in his 401k. For now, let's just assume we're going to put it in international stock. And let's say it has FTIHX, good international stock fund. Okay, so now we're done with his 401k. We've filled out the entire bond allocation in that account, and we've filled up his 401k, so we can see the allocation down there. So let's continue. So next you might want to think about your Roth IRAs. Those will often be very flexible. But some people like to maybe place a bet that their US stock is going to grow the most. So maybe they just want to put all their US stock in the IRA. I used to do this. I don't really do this anymore. I'm diversifying my stock exposure in my IRAs now that it's getting, the IRAs are getting quite large. I don't want to have such an all-in bet on US stocks. Let's say for this couple, they've decided to do that. So hers is $35,000. Okay, so now we can see we filled in both of those accounts. They're entirely allocated to US stocks. And we still have quite a bit of the portfolio to allocate. So often next you might want to do taxable. So one advantage in taxable for international stocks is you get a foreign tax credit. I covered this in my other video. This is actually very nuanced and it warrants a completely separate video. If you end up growing your income a lot, making a lot of money, it can actually hurt you a bit. Or if you have a very large portfolio in retirement. I'm going to cover more nuances of that in a future video. But for most people that aren't going to have a very high income or very high portfolio in retirement, it might make sense to take advantage of that foreign tax credit. So we're going to assume this couple wants to do that, and they're just going to allocate their entire taxable portfolio to VTIAX. It also pays a bit of a higher dividend than VTSAX. So now we've allocated that. So now what's left is her traditional 401k, and we need to get our balances desired allocation to match this 50-30. So we need US and international stock. Let's just say we use the same funds. And then I happen to know that the value to hit the allocation will be that. Okay, so now we've allocated all their investments across these different accounts. We've optimized it a little for taxes. We've considered that the 401k had crappy funds for some of the funds. Luckily, we had a decent bond fund. And maybe this international stock fund is a crappy one. This is actually a good one that I put as an example. But we've made some of these considerations, trying to optimize for taxes and fees and different placement. And we can see the overall portfolio now looks like this. There's much fewer positions held in the portfolio. And in some cases, we're holding entire allocations in one account, like the bonds. For the whole portfolio allocation, it does have a little bit more complexity, but as we saw, we have the tax efficiency we could possibly get. Could often have lower fees. It can help us reach certain investment minimums. And in some cases, it can make rebalancing simpler. If your whole allocation to bonds is in your 401k and you need to increase it a little bit, well, you just sell a little bit of the stock in that 401k and put it into bonds. That could be much simpler than having to do it across every account in your portfolio. It also eliminates those small allocations in one account, like a 5% REIT allocation could be a pain to get in a small taxable portfolio or Roth IRA. So I'm going to dig in a little bit more to the complexity. This is something you really want to consider when you're doing portfolio design. Think about how much of the complexity is actually going to be worth it to you. So some of the things that can happen here that can further complicate this asset allocation across the whole portfolio is one account getting too big. That might just make it difficult to work around if just one of your accounts is so big, or maybe you stop contributing to one of the accounts and that's where you have your entire bond allocation. Now you might have trouble doing rebalancing. There might be different fund limitations, like maybe there's only an S&P 500 in your 401k, but you really want the total stock market exposure. For instance, my wife's 401k has a developed international index fund. And that's really the only good international fund in there. And you could just say, hey, the S&P 500, the developed international, close enough, not ideal, but we'll just keep it simple, close enough for me. Or you could try to work around it by adding an extended market index in your IRA or some other account to complement that S&P 500, which is the only good fund in your 401k. Or in my wife's case, maybe we add an emerging markets index to our Roth account to compensate for the fact that her 401k only has the developed international fund. These are all some different complications that you can run into. Additionally, you want to think about how you're going to withdraw from the portfolio when you're in retirement. You might want to project how large your different accounts will grow to and how you might take the distributions. So make sure you at least consider that to some degree, because as you age, it is going to get more complex. You'll probably have more accounts, you'll have changed employers, you're going to have more money, and so on. The cost of making changes might be higher due to capital gains, and so on. So you really want to think about this, give it some thought. Even though it seems very simple on the surface, it can pick up a lot of complexity over time. Another one that we didn't talk about is asset protection. For instance, I made a video on asset protection, which I'll link below. It's a very interesting concept you should be aware of. But one of the great things about 401ks is you can keep them through bankruptcy. That's federally protected by federal legislation. IRAs might be protected in different states. But if you're following this strategy of putting all your bonds in your 401k, you have all stocks in your taxable account, well, your 401k could be much smaller compared to your taxable account, and then you lose some of that asset protection that you could have with stocks in the 401k. So there's a lot of things that can go into this, and I don't think you should get stuck in analysis paralysis. Like, I'm an engineer, I like optimizing, I like precision, and this is often difficult when it comes to investing. Sometimes I just have to let that go. For instance, I used to care a lot more about having a very precise asset allocation. Every month I would think about, how am I going to contribute to my portfolio and keep the asset allocation in balance, and recalculate what I should be putting in each account into which fund. Now I just look at it every few months and I change my contributions if I'm getting too far out of balance. I don't really worry if I'm a couple percent off. So reeling it back in, there's a lot of complexity that could potentially creep in if you're trying to optimize these different things in your portfolio. For some people, they may not be confident doing this. They might want some professional advice or help with this. That's fine, just be aware that that might be you. Or you might just be fine not getting some of these little optimizations, just keeping it really simple. Maybe you just pick a target retirement date fund and go with it. Or another option in the taxable account, you might just pick a fund like VT, the Total World Stock Index. And then maybe you do some of the tax optimizations in your retirement accounts where there aren't really tax consequences for rebalancing. That's another strategy, kind of like a hybrid. I just wanted to explain these different strategies, some of the considerations you should make. For every person, the goals are really different. That's what we have to come back to. How you achieve your desired asset allocation, how scalable you want it to be, how simple you want it to be. If you want to trade a little simplicity for tax efficiency, possibly lower fees. I personally prefer the whole portfolio allocation, as I do try to optimize for some of those taxes and fees. However, I wouldn't fault anyone for choosing simplicity and going with the mirrored approach. Some people might just want to say, screw it, I'm going to focus on earning more money instead of trying to make these little optimizations in my portfolio. And that's probably the best thing to do anyways. Impact your financial planning the most is if you just earn more money. In the end, I think most people following solid financial plans will probably reach their goals either way. Probably doesn't matter all that much. What matters most is creating a good plan, living below your means, growing your income, investing more, and sticking with the plan. Let me know what you think about how to allocate assets across different accounts. I'm interested to hear how you do it in your portfolio, and if there's some things we discussed today that you didn't think about. Thanks for watching, everyone. If you got value from the video, make sure to like and subscribe below and share it with your friends. It helps me out and helps support free financial education. Later.